Hello traders, Gary Wagner here for Trending Markets just before 11 o'clock in Honolulu, just before 5 o'clock in New York. It is Wednesday, 19th of August, 2015, and this is Trending Markets. Before we get to oil, which is our only active trade, I do want to take a look at the S&Ps and the Dow Jones Industrial Average, of course, under tremendous pressure today. S&Ps closing down about 23 points on the day. When we look at that in relationship to any kind of a moving average, because that is what the majority of traders follow, is that 200-day, that long-term moving average, we are at a very, very precarious point in time. You can see that we've closed right around there. People are saying pretty much 2070 is the mark to watch. You can see we've closed roughly at 2072, but we are right at that point where, according to many technical traders, if we in fact breach this particular point, this 200-day moving average right in here, we could see a sizable sell-off in the marketplace itself. Now, we've been looking at the Dow Jones Industrial Average at that channel line, and that is also now broken below. So we want to take a look and see how this market reacts, because we could have a tremendous short play in this market in the days ahead. So traders, it's something we want to just kind of keep in the back of our heads. Let's take a look at crude. That is our only active trade. As you know, we went short. A couple of days ago, we went short, I believe, at 41.67. The following day, meaning yesterday, we absolutely had this market firm up. It firmed up about a percentage over 41, went back to 42 and change, roughly 42.50, somewhere in that area. But it has dropped almost 5% today, down $2.07. So now our short of 41.67 is actually gone in the money, and in the money in a considerable way. Where do we think this market's going? Well, we haven't really changed what we're looking at, in that it has been my belief, and we've been talking about this throughout the last couple of weeks, that once we breach the particular double bottom, and that was matching it right here at 42. Let's go ahead and kind of extend this line right in here. But we talked about the fact that once we broke this, and that was what precipitated the trade, one of the key factors in me actually pulling the trigger on this trade, and that's why we got in at 41.67. It had to break below 42 for me to really have a solid sense or feel for the market. We saw the market recoup. This is the point that we put the trade on. It is this small little candle here, and you can see it closes under that point. In other words, it tests that price point. The following day, it closes above that. That's yesterday. And today, we had this dynamic break below. Now, as you know, I have been looking at the potential for oil to go through 40 into the 30s, the high 30s. And I looked at the possibility of 37 and 38 as a price target. Have I changed that perspective? Well, as of right now, I have to say no. I still think it has the ability. We have not broken, nor have we closed below $40 a barrel, but we have historical precedents of the market moving from those rapid highs to those rapid lows. And so traders, once again, I draw your attention to this one Japanese average chart that we have been using as a primary chart tool, and I believe it was just yesterday that I compressed this chart, as I'm doing now, to look at these real strong lows that we have, and they're sitting just above $30 per ounce. You can see them right in here. The bottoms, I believe, touching at around 31 or 32. We can definitely see in a defined manner how we have now broken through this particular price point, and most importantly, we have precedents for this market tracking above 100, trading to $30 a barrel. It has happened before. So the real question is, could it in fact happen again? Now, one thing that it is important to draw your attention to is the timeline that we're working with in terms of when this market broke last time and when it tended to bottom out. Realize we are in the middle of August, and typically from here up until about November, After August ends and we go September, October, November, those are the points in time when oil has the least utilization, the least amount is used, because the summer driving, so to speak, is over. We're not yet into the winter months when you get heating oil and other forms of oil being used for winter. And so the fact of the matter is that this is absolutely a simple supply and demand scenario. The kind of trades that I like, in which they are not so much that they're clear or easy to figure out, but there is definitely kind of that reaction of the doctor hitting the little hammer onto somebody's knee and the knee kind of flips up. You know what to expect if supply goes way high and demand stays constant or diminishes. The other thing that you've got working in favor of lower oil pricing is the fact that the Saudis have really pumped up their production right now, and it doesn't look like they're diminishing. And until oil prices get to 35, 34, you're not going to see a lot of the shale production shut down. Then it really has to. It's not profitable at that point. But you've got a standard supply demand scenario, I think, that warrants the potential for lower pricing ahead in oil. And the whole thing about trending markets, the reason that we developed this was that if there are opportunities in certain markets that have clear, defined trends that we believe we can profit on, because we only need a couple of really solid trades a year to really change our portfolios in terms of overall ROI. If we have a couple of these home runs a year, we could certainly see some nice results overall. But to do that, we really have to kind of open the playing field to whatever markets are out there. And if I see corn or wheat or any market that I feel has the potential to have those really clear, defined trends, those are the markets that I'm going to recommend. That's the whole idea behind trending markets. So I believe we've got a really good trade here. We're going to keep our stop where it is. I don't want to get stopped out again because we moved it up too tight, only to see the market retreat the following couple of days. Those trades don't please me. Even though they're slightly profitable and they're not a drawdown, that's not the way we want to go about it. So we're going to keep the stop where we have it currently. We are going to maintain our current short position. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily update in trending markets. Bye-bye.